And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Yes, it's hard to believe it's Friday afternoon already. Luke Smith, good afternoon.
Good afternoon.
I know, we wait all week for Friday and then bang, all of a sudden here it is.
Oh, it's honestly, I feel like I'm here every other day at the moment. The weeks are ripping by at a frightening pace.
It has been a busy time, but of course that helps the time go more quickly, doesn't it?
Well, I think that's a good thing or a bad. It just depends on which side of the ledger you're on there. It's Monday to Thursday seems to take forever.
And then all of a sudden, here we are.
Exactly.
Today's topic, ways to get money into your superannuation to fund your retirement. Now, of course, we all know that as we grind out the 9 to 5 weekday slog week after week, our employer is dutifully putting aside a little bit of money for our superannuation because the law says they have to.
Correct.
But there is more you can do.
That's right. So we spoke last week or the week before about how much do I need to retire, and this is really a segue from that, in that we're going to throw around some ways that people can bolster their super, because a lot of people come in and go, well, I max out the 30,000, that's it. I go, well, no, there's a raft of other things you can do, and that's really the context of today is, well, how can you get money into super? And what are the options that are available to you? And that's a really good starting point. $30,000 is the concessional contribution cap. That's the most you can put in from any source and claim a tax deduction. So you might get 15 from work. You can put in 15 and you get a tax deduction for doing so. Now, two ways you can do that. One, old school, salary sacrifice through your employer. So go to them and say, hey, I want to get 15 grand in between now and 30 June. And given that we're in July, great time to start because it's a lower fortnightly amount than if you start in January, for example, where more of your pay will disappear into super to achieve that same 15,000. Another big misconception or thing that gets missed for me is make a personal contribution. And people go, what? Take your own cash from wherever, put it into super, and then send to the super fund a notice of intent. Now, that form is really, really important because it tells the fund, hey, Mr. or Mrs. Fund, I've put in 15,000. I'm claiming 15,000 as a tax deduction. So no form, no deduction, right? That one really, really matters. But that is exactly the same tax outcome as salary sacrificing every fortnight or throwing it in on the 1st of June and claiming a deduction in July when you see your accountant. You get exactly the same net tax benefit, but two different ways to do it. If you're a maniac and you can't save, salary sacrifice is great. It's a forced responsibility. If you are diligent and you've got a mortgage, I always say to people, fill up your offset account during the year, pay down your mortgage, and then pull out of that to make the contribution in June, and you've got two uses for the same money. An extension of that is the catch-up concessional legislation. That's where you take whatever you haven't used of your annual limit, looking back 5 years, and you throw that into super. So you might go in that example, we said 15 from work, 15 from yourself. You've reached 30,000 this year. But if you didn't reach the limit in 21, 22 and 23, because you might have been on mat leave, you might have been contracting, you might have been studying, you might have been working part-time, and now you're working full-time, you can look back and say, oh, I've got 10,000 of space in that year, and that year. You might pull money out of your offset account, throw that in and claim another 30,000 as a tax deduction, where your total super balance is under $500,000 at 30 June. So that's another great way to get money in leading up to retirement to maximise the tax-free pension you can take from 60. Another option is to make a non-concessional contribution where you're putting money into superannuation, but you are not claiming a tax deduction. And a lot of people confuse this with a deductible contribution, or they say, well, the limit's $120,000 a year. Is that less the $30,000 that I put in as a deduction? No. You can put $120,000 in. You can not claim a deduction. You can put $30,000 in and claim a deduction. They are not mutually exclusive.
So they're two separate caps.
Exactly right. Now, an extension of that is, I've just sold an investment property. I've just inherited some money. I've just sold my business. You can put in 3 times that $120,000, provided you have room in your total super balance, and you can put $360,000 in one go. So that's a great way to bolster super, to get as much as you can in before you start a pension. Another one that people are becoming more familiar with, because they've reduced the accessibility age, is the downsizer legislation. So you can sell your primary residence because the kids have moved out, you're rattling around in a big house, and you go, well, I don't want to clean this thing anymore, and you've got a lot of value tied up in a non-income producing asset. You might sell your house for $1.5 million, buy a townhouse for $1 million, wherever you want to live, and that $500,000 you can add to superannuation in addition to all of these other thresholds. And that limit is $300,000 per person per lifetime. So in $500,000, you might do $300,000, your spouse might do $200,000, or however you cut it up. And you can do that in addition to the $120,000. You can do that in addition to the $360,000, and you can do that in addition to the $30,000 of deductible contributions. So there are so many ways that you can use legislation to maximise active saving into super. And when people go, well, why would it do that? Well, if you're over 60 and start a pension, you pay no tax taking it out, and you pay no tax inside your super fund. Now, depending on the type of super fund you have, you might have $1 million building that you own outright. You might have 4 investment properties in there you own outright. You might have $1 million worth of ETFs and shares. Whatever it is that's in there, you're paying no capital gains tax on the sale of asset and no earnings on the income that's generated inside the fund. So you're crazy not to be building up your superannuation, regardless of what you decide to buy with it, because it is the most tax-effective vehicle. Now, they'll do their best to try and blow that up in the Parliament. We all know that's coming in light of proposals that we've seen of late. But while that is so, it is going to be a very tax-effective way of holding things. For the self-employed people out there, the capital gains tax small business concessions are absolutely wonderful, because there are 4 or 5 different levels to that legislation, where if you sold your business, if you've owned your business for more than 15 years and you sell it, there's just over 1.8 million you can get into super, no tax. If it's been an active asset, you can get a 50% discount. If you've owned it for more than 12 months, another 50% discount. Then there's a $500,000 rollover relief per person that you can roll straight into super with no tax. So that example there is where a good accountant can add massive value to a sale transaction, get money into superannuation, which is a tax-free vehicle, and then fund yourself in retirement. And you've made the most of the 20 or 30 years you've killed yourself in your business, so that you can maximise and extract all the value you can in the best, most flexible way possible to be able to live the way that you want to live. So, you know, there are a number of ways to get things in, and we just want to get people thinking about, well, is there something I'm missing out on, or have I assumed that this equals that? And it may not be the case.
So obviously the reason for stuffing as much money into your superannuation account as possible is so that you've got sufficient capital in that account to provide for your retirement income. So how close to retirement do you need to be thinking about this? Can you do it the day before you retire and then switch over to a pension income?
Yeah, look, fantastic. So to answer the end of that question, yeah, you can turn a pension on any time you want over the age of 60, provided that you've met the requirements to do so. Now, to start a pension, you need to say, I've ceased gainful employment, i.e. I've quit. Now, that could be one of 2 jobs over the age of 60. And then you start a pension within your superannuation fund, which just simply says to the superannuation provider, hey, I'm not putting in any more money. Now I'm going to start taking some out. And as we discussed, in a previous show, the word pension does not mean fortnight. It just means I'm taking a prescribed amount of money out of superannuation at any frequency that suits me within a legislated percentage, and that's dependent on age. So you can turn one on any time. In relation to getting the money in, there's a few steps that you need to consider in relation to the legislation of the type of contribution you're making, and also then the total value of the assets that you have. Because we've spoken in previous shows about the total super balance, which is currently 2 million. But if you're really close to that, it precludes you from using that full 360 window of contribution space for non-concessionals. You can still make deductible contributions. You can do a downsizer on the Monday. You can start a pension on the Tuesday when the money clears. Provided your admin from a fund perspective is on point, you can get a lot of money in very, very quickly. So you could go 360 downsizer. You could go, 360,000 non-concessional. You could put in 30,000 deductible. You could put in 500,000 rollover relief, and you could do a downsizer payment all in the same week, and you'd have in over $1 million. So provided you use it properly and prepare for your access date, with some preparation, you can get a ton of money into super.
And then start a pension the following week.
The following day. It's a beauty.
Excellent news. Luke Smith from Envision Financial is with me in the studio today, and we're talking about ways to get money into your superannuation fund in order to provide for your retirement. So what are the key things for people to remember about what they can do?
So we want to think about boosting retirement, because we spoke a couple of shows back about, well, how much do I need? So to address the amount of capital that each individual may require, one, make your deductible contributions up to the $30,000 limit if you can. And you can do that by going to your employer and saying, I'd like to salary sacrifice over the next 12 months. Or you can leave it until June and throw the money in yourself. But if you do lodge the contribution yourself, you must lodge what's called a notice of intent with the fund. If you don't lodge that form, you won't get a deduction. So there'll be tears, and they won't be mine. Use the non-concessional rules. So as we said, that's a separate test. That's $120,000 a year or $360,000 in one go, provided you have room in your total super balance. So make the most of that. If you've inherited money, sold an asset, sold a business,
won the lotto, somebody's died, you sold one of your kids, then you've got the downsizer legislation that people are now more comfortable with, because you've got to be over 55 now to use that, which is great. It was previously over 65, which precluded people from being able to do it, but they've brought that eligibility age right down. And that's where you've owned a property for more than 10 years and you've met a number of other criteria. You can sell that and put $300,000 per person into superannuation on a tax-free basis, in addition to any other test. You've then got, for the self-employed people, the CGT small business concessions, where you've got a 15-year exemption, you've got an active asset exemption, you've got a 50% discount for the duration of your business, and then you've got $500,000 rollover relief per person, where you can make a super contribution, again, in addition to downsizer, in addition to non-concessional, in addition to concessional. So all of these things can be done in conjunction with each other, and you need to make sure that you have room in your total super balance. But you can make a CGT small business concession and be over 75, which is great. You can make a non-concessional contribution up to 75, which is pretty good. You can make a deductible contribution up to 67 without having to meet a work test. And you can make a downsizer contribution at any age. So when we think about superannuation doors shut at 75, if you did the downsizer over 75, you're still eligible to make a contribution. And for the technophobes out there, you can make a downsizer contribution and be over your transfer balance cap and have it sit in the superannuation fund, because that's a question I get a lot. Oh, I'm over my transfer balance cap. Can I make a downsizer contribution? Yes, you can. So there's a range of ways there that people can get money in. The other thing you do want to think about that we didn't touch on before the ad break, if you've got assets outside of super, capital gains tax permitting, you can actually transfer them into super. So if you've got $250,000 of CBA shares and the capital gains isn't ridiculous, you can transfer those into your superannuation fund without needing to cash out and buy them back. And that's called an in-specie transfer. So you can also move assets into super and build your assets that way. So range of options. Don't confuse them with how they go together, and just make sure you're staggering money in before you retire. Indeed. So where can listeners get more information?
Yeah, office number 62604749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube. We've got a backlog of all of our shows. And we've got the book, Smart Money Strategy, Your Ultimate Guide to Financial Planning, which is available, let's just say, everywhere.
In bookstores and online. There
Correct.
we go. Luke, thanks very much.
See you next week.
We'll catch you again next Friday. Luke Smith from Envision Financial will be back again at the same time next Friday afternoon to talk more money matters for you.